numbers.
Yes, for the full year, right?
For the full year.
Okay, and margins I think would have come in at 25.7% for FY17.
25.7, yes.
Yes, so I was just calculating that. So that means already for FY17, the company has missed its margin guidance band of 26 to 28%. So for one, full year growth has come in at 6.2% in terms of the dollar terms. This, I'm just trying to recollect what the growth was in the prior year. But 6.2% is what the company has done in terms of the full year performance in dollar terms. This would compare with 7% in the prior year. In constant currency, last year the company did 11.9%, which has come down to 8.5%, which means there has been a fall of 340 basis points in the company's constant currency revenue growth on a full year basis. And on a full year basis, the company's margins at 25.7% are lower than their own, margin guidance of 26 to 28%. So there is a case that perhaps the company, should go ahead and at least warn the street about the margin pressures going ahead. We are getting in reactions. Apurva Prasad of HDFC Securities here. We're getting in reactions from Angel. We have Karan Taurani as well. Sarabjit Kaur Nangra of Angel is here. But Apurva, first, your thoughts on the numbers. Does it meet your expectations? If yes, if it's lower, how do you expect the stock to react?
Yeah, hi. So yeah, it's more or less in line with the estimates. If you see on the revenue, we were baking in about 1.9%. They've delivered about 1.5% dollar revenue. On the margin side, we were slightly lower than consensus, so it's more or less there. So we were at about 25.3. They've come about 25.7. So prima facie, it looks more or less in line type numbers with what we were expecting.
Okay. Karan, your thoughts? Does it meet your expectations? Because it appears to be a tad softer compared to the CNBC TV18 poll.
Yeah, the numbers are fair and they're largely in line with our estimates on the revenue front as well. We were anticipating a growth of about 1.6 odd %. They've delivered about 1.3. If I can get that wrong, correct? I didn't get the number actually. Even the margin as well, the margin has declined by about, we are expecting a dip of about 50 bips and they've come at similar levels. So they've come largely in line. It would not be a huge reaction in terms of stock price performance tomorrow.
Okay. And Sarabjit, same question to you. How would it compare with the Angel estimates?
See, we were on the higher side. We were looking at around 1.9. So in terms of margins, also around 26% EBIT margin coming in. Net profit estimates were also a bit higher than what they delivered. So for me, it's overall lower than expectation, I would say. And the surprising part is that in spite of our numbers being higher on the top line, and definitely the key metrics, if I have to look at the top line growth, in spite of which margins have marginally, we were looking at 26, they had delivered 25.7. So I think that is something which is kind of positive, given that revenue growth is more or less not in sync with what street was expecting, but margins have kind of squeezed in to be in lines, some slightly in line, not exactly. So I think that's something positive area. Rest I think is lower than expectation.
Okay, some more details which are coming through. North America has not done well for the company. North America in constant currency terms has declined by 1.8%. Latin America, which had a very strong growth in the prior year, 12.5%, has declined by 7.3%. So that, LATAM we know is very volatile by the company. But North America declining by 1.8% on a quarter-on-quarter basis does not bode well, considering the company gets nearly 54% of its revenues from North America. India for the second straight quarter has done quite well. It was a 10% growth the prior year. This year it's a 9.3% growth again. But India tends to be extremely choppy, so we wouldn't set too much store. The key growth markets of North America has disappointed, down 1.8% over there. UK and continental Europe have seen a fairly good growth, 4 and 7% respectively. BFSI and retail seem to be the other disappointing verticals by the company. BFSI, for instance, is down 0.4%. On a quarter-on-quarter basis, retail has declined by nearly 3%. BFSI is important because it's 40% of the overall revenues. And in the company's conference call in the prior year, they had said that there was a sense of buoyancy in, and I'm quoting verbatim, there is a sense of buoyancy in customer sentiment, particularly in the BFSI sector, but it's not translated in terms of numbers. In terms of disappointments, I would say it's North America, which is one where it's declined by close to about 1.8%, and secondly, it's BFSI where it's down 0.4%, and retail too has slowed down considerably. It's a decline of 3% seen in retail. Other verticals have grown quite smartly. So communication and media has bounced back. Manufacturing, it's a steady growth. Life sciences is up nearly 3%. High tech is 5%. But these are again are much smaller verticals for the company. So in terms of disappointments, in terms of what is driving some of the softness that we've seen, it appears to be BFSI as well as North America, and retail as well, which contributes close to about 10% of their overall revenues. Asset leverage solutions. Remember, this current CEO of the company, that's NG Subramaniam, was earlier tracking the asset leverage solution. It's about 3% of their revenues, but that's seen a decline of nearly 5%. Infrastructure services has also seen a decline of 2.8%. Again, we're just getting into, the nitty-gritties of the numbers, but on the whole, I think these don't seem to be a fantastic set of numbers. They appear to be on the lower side, but digital continues to grow quite well, up nearly 29% on a year-on-year basis. Urmil Shah of IDBI Capital is also with us. Urmil, you're going through the details as we speak. Your thoughts?
So on the revenue front, it is in line with our expectation, about a 1% CC growth. But there's a miss on the margin front. We were expecting margins to remain flattish. It is good that, digital has grown well, but still the YOY growth of 23% is, slower than the growth for the full year. One positive part is that there is a addition back in the $100 million clients, and the $50 million clients have continued to see an addition.
Do you get the sense that FY18 might be a better year for the company, Urmil? FY17, the company's delivered 8.3% in constant currency. Your own estimates for FY18, and would there be any changes that you would make to the EPS estimates?
So for FY18, we are expecting about a 8.5% growth on a CC terms. So to that extent, on the revenue front, there doesn't seem to be a change required. Of course, we'll look at more details on the call. And for EBIT for next year, we are expecting a 25.6% for FY18. We'll see what is the kind of investments maybe on front end and sales and marketing they would require.
Okay, just let's get in some more reactions. Karan, you said the numbers are largely in line with your expectations. So the stock reaction, according to you, what should it be?
Stock reaction would not be a significant one, really. I mean, given the negative sentiment in BFSI and US not doing well, you could see the stock, going down by about 2-3% odd. But nothing major as such in terms of downside, because in terms of valuations, if you see, the stock is already trading at about 15.5-16 times FY19 EPS. And we believe that, large cap IT vendors, as the growth is clearly coming down, we believe these are fair valuations and do not offer much scope for downside from current levels at least.
Well, is there a case for the company to lower its margin guidance band, considering in FY17 it's come in at 25.7%, lower than their own target?
You saw Infosys lowering their margin guidance by about 100 odd pips, and similar could be for TCS as well. So in our estimate currently, we've got a EBIT margin of about 25.5% for FY18. You could see that lowering down by 40 to 50 pips another, and because there's rupee appreciation, which is a major headwind. So as for Infosys, even for TCS, that would be something which would be factored in. Plus for TCS, the visa cost would again be a very high component, because they also have a significant amount of on-site base. So higher on-site cost would also have an impact on margin. So probably it could be a little bit higher than Infosys in terms of margin impact, but yeah, surely we expect the margin guidance to be revised downwards for TCS as well.
Apurva, 8% growth this year, 8% growth expectation next year. Many people make this case that their valuations are low, but stocks do well when earnings are expected to grow or earnings estimates are revised upwards. There is no case for that here. I mean, not just for TCS, for Infosys and maybe others as well. Maybe we will see a small 2-3% reaction tomorrow, but over a period of time, do you suspect stocks can derate?
No, so there has already been a fair level of derating if you look, overall at the sector. If you're comparing vis-a-vis the highs, they're off almost 30%, in terms of valuations. If you look at the mean levels, they're off more than 20%. So there has been a fair amount of derating of the sector. The question is really, where does the earnings deceleration stabilize? Where I think that's really the question to ponder about. So there are a set of headwinds. I think for the foreseeable future, the next couple of quarters, we see very clear headwinds. So it's actually a function of where that stabilizes. So what also is important is what they do on the payout side. So that's something in the last one quarter many of these companies have stepped up, especially in the payout side. So I think that should also to an extent be supporting valuations. But the question really is, where does the deceleration in earnings stop?
Okay, Moshe Katri of Wedbush Securities is also here with us on the phone line. Moshe, your initial reaction to TCS's numbers?
As expected, muted quarter. Nothing.
Okay,
On what impacted margins.
We'll just try and reconnect with you. There is a bit of an audio glitch right now, so we can't hear you very clearly. But, on the whole, as he rightly pointed out, these appear to be a muted set of numbers. On all parameters, at least in terms of revenues as well as margins, it appears to be on the lower side compared to consensus expectations. Sarabjit, do you believe that the company will lower its margin guidance band, and will that be taken negatively, or do you think it's priced in?
I expect some kind of caution on margin front, definitely given the backdrop of what is happening at the US front. So I'm expecting a lowering of guidance in terms of margin. But yeah, as in terms of factoring, I guess the valuations, if you look at in IT space, I guess the stocks have already underperformed enough to factor in that. So I guess what kind of a margin dip Infosys has given, and if that comes through, I think there could be the stocks are already kind of factoring in that for the next year, I guess. So.
Urmil, if we see a bit of a dip in the TCS stock price tomorrow, would that make it a good opportunity to go ahead and acquire, buy some make some long positions in the stock?
As Apurva was mentioning, even we believe that next 2 quarters there are going to be headwinds for the sector as a whole. And given TCS's dependence on the US, it also should have impact to that extent. We are having a hold recommendation on the stock right now, and our target price is 2245. So we don't see that there would be a significant upward revision. So to that extent, we would continue to maintain a hold recommendation.
Apurva, a lot of hope was based on the recovery of the BFSI vertical. Considering that US banks had started doing well ever since Trump came in, there was hope that his regulation would be favorable for US banks, and that would drive further spending by the US banks, which could benefit companies like TCS, considering the high leverage that they have to BFSI in North America. But at least this quarter, the performance appears to be a bit muted. BFSI has declined by 0.4% on a quarter-on-quarter basis in constant currency. Would that alter your growth estimates?
Yeah, so I mean, it's actually quite interesting, the fact that this is quite a contrast to Infosys. If you look at BFSI in North America, as compared to Infosys, where there was actual outperformance. The structural common theme out here between the two that I see immediately is the weakness in the retail and CPG segment. So I think that somehow, is looking like, a trend. But yeah, I think BFSI does matter with TCS with such high share and BFSI. I think we need to really understand which pockets is this really. So it looks more like a Northam type of an issue, but we need to really understand, probably dig deeper. It could be the Diligenta part. Diligenta was coming off, so we'll probably wait for management commentary on that to take a better call.
Apurva, so we will hear from the management in just a bit, and we'll have an opportunity. Our colleague will have an opportunity to put some questions across. What would you like asked of the management?
Yeah, so first things, the large client bucket of TCS that has been a strong lever for them. It had come off the last few quarters. So I think that how they see that and how the performance. I missed the large client performance. I think that is one key monitorable. The other is I did not get the digital and the legacy split, which they typically believe. So the digital has been at a run rate of about 30% or so. It's really the legacy piece, which is still a bulk of the revenue, which is pretty flattish. So I think any trends on that, any commentary on that would be helpful, as well as the onshore strategy, especially with the kind of dependence which is there on H1B, which is
I think you're about to get all those answers. We have the CEO taking the mic. Let's listen in.